Tens of millions of Americans face an unthinkable crisis. I'm Steve Van Metre. Delinquencies are skyrocketing, finances are breaking, and the worst part is, this nightmare is just beginning. Now let's head over to the Wall Street Journal where we find out why this nightmare could be worse than the global financial crisis. As credit card companies brace for a downturn, Americans are still spending. We note, of course, that's due to front-running the tariffs, but right now banks are putting away more money to cover potential losses because what they're facing is an economy that's going to rapidly slow down, and the evidence is already mounting that what's happening in the consumer space with rising delinquencies indicates that the situation right now that most American households are facing is worse than it was going into the global financial crisis. An economic downturn could mean more customers can't pay their bills, and banks and credit card companies are trying to get ahead of it. Already, delinquencies are rising or are now in line with levels just from before the pandemic. JP Morgan Chase and Citigroup added money to their rainy day funds to cover expected future losses. Retail card issuer Synchrony has tightened its lending standards, making it harder for its customers to get credit. U.S. Bancorp is going a different direction and chasing a more affluent customer base that could better withstand a downturn. And now we're hearing from the banks that the base case is that the U.S. economy is going to continue to slow down. And as paychecks shrink against rising inflation, one of the problems is as more American households go into delinquency, and as they enter delinquency, we face what is now the next financial crisis. And it's looking ugly because the data suggests it's just as bad as it was going into the pandemic and as bad as it was going into the global financial crisis. There are some early warning signs as consumers are holding off on non-essential splurges such as vacations. And the issue isn't that consumers don't want to spend on the discretionary side of the economy or that they don't want to go on vacation. The reality is essentials, or what we call consumer staples, are rising in price, and there's an expectation they're going to continue to go higher. But the problem is American households, when they look at their budget, they can't afford higher prices, so they have no choice but to cut spending on the discretionary side of the economy. And the share of cardholders making only the minimum payment is running above pre-pandemic levels, as according to Capital One, suggesting that, again, paychecks are shrinking against rising prices, and this is putting strain on household budgets, pushing some of them into delinquency. But as other households are forced to make the minimum payment, they're now one step away from being in delinquency, and the risks are high because what we're facing now from employers is hours worked are about to shrink, and based on the relationship you're about to see, it means the delinquency rate is going to skyrocket. Let's take a look at the delinquency rate on credit cards in blue against average weekly hours of production of non-supervisory employees in red. And you can see the direct relationship between the two, because when hours worked go down, as we see here back in 1994 through 95, the delinquency rate headed higher. And this was just an indication that paychecks were shrinking against higher inflation. Consumers couldn't afford everything, so they started going into delinquency. You can see that happens again going into the dot-com bubble. As of right around 2000, paychecks are shrinking as hours worked drops, and next thing you know, delinquencies are on the rise right into a recession. We see the same thing going the global financial crisis, what is nearly a mirror relationship. As inflation headed higher due to rising energy costs, consumers couldn't afford it, so what happened? They entered delinquency, and next thing you know, as the discretionary side of the economy fell apart, hours worked plunged, and the delinquency rate rose. We can see it happen again going into the pandemic, and now we're facing the same reality. The reason we've seen here recently delinquency rates dip a little bit is because hours worked have jumped as many employers were looking to front run the pandemic due to an increase in demand. But what we can note starting next month alone, what we're seeing is, of course, imports into the U.S. expected to plunge. That means demand is also going to go down along with the demand for labor. The first thing that gets cut is hours. And next thing you know, for more households, the only choice will be delinquency. And consumer sentiment has been sinking over the past couple months, fueling concerns that will cause people to slow their spending. That hasn't panned out, but banks are still setting aside reserves. Well, it is going to pan out because the real issue here is that when confidence goes down, people's spending drops. But why right now is confidence falling and spending not dropping? Because everybody's front running the tariffs. That's the real issue here. They're trying to buy everything they need while they can before prices go higher. But something that should also be going higher, that's your trading account. We told our Momentum Timer Pro subscribers to buy Bitcoin right here on the 14th, and it took off after that. How did we know to do it? Well, because we saw the momentum signals were rising, we saw the trend was rising, and we still think there's more upside. But the best part is you could have gotten this trade for free that's now up over 10%. Grab the links in the description below. Use the coupon code for your free 30-day free trial, and stay tuned to the end of the show for more information. Because let's talk about the relationship between confidence and spending as we look at now the University of Michigan Consumer Sentiment Survey in red against real or inflation-adjusted retail sales in blue. And let's go back to the dot-com bubble, and we can see in late 1999, retail sales peaked and slowed down, but what happened is consumer sentiment hadn't rolled over yet. It wasn't until we saw a big drop in sentiment that you see a further decline and eventual contraction in retail sales. So you can see there's a bit of a lag as consumers remain optimistic about the economy as we see here in 2006, but their spending habits didn't show that. When their confidence does start to plunge, that's when we see spending evaporate. We can see it happen here around 2021, confidence plunged, and with a lag, retail sales fell lower. And now what? Confidence is plunging, and the experts are saying, well, it's not impacting spending. Well, not yet. Let's just wait about another month, and what's going to happen is you're going to see spending drop, because we all know prices are rising, and the worst part is they're expected to rise significantly due to the tariffs. Unemployment among white-collar workers has remained low, which has helped keep people out of delinquency, but as you're about to see, that's going to change in a major way. And right now, that's insulating some companies from risk in their credit card portfolio, but what's going to happen is it's going to get even worse, as what we're facing is a situation that there's going to be major job losses, and hours worked is going to be the first shoe to drop. That's going to plunge, and next thing you know, you're going to see a lot of Americans on the unemployment line, and at that point, tens of millions of American households are going to be facing delinquency with no answer in sight. Filings for unemployment benefits have remained relatively subdued in recent weeks in the face of uncertainty about tariffs and the economic outlook. New claims have been within 5,000 of the 220,000 mark for 8 consecutive weeks. And historically, my friends, this number is very low. So what you're seeing here is employers are not willing to lay people off at this point. There was a point where they were, but right now they're holding steady. And this is good news, as it indicates in the midst of all of their caution, businesses are not resorting to widespread layoffs. So what we're hearing from business executives, they're not happy about the tariffs. They're not happy about taking a hit at the margin, but they also don't want to lay people off, because if these tariffs go away and the economy turns around, they want to make sure they have the workers in place. The issue is, if this trade war continues, there's going to be mass layoffs. Now, I want to know from you and your job, are you worried about losing your job in the near-term future? Are you relatively confident? Are you seeing that no matter what happens, you've got work? Weigh in the comments below. I want to hear from you, because continuing claims of proxy for the number of people receiving benefits fell to 1.84 million in the week ending April 12th, now the lowest level since the end of January, as we're seeing people come off the unemployment line and find work. Now, if you think about why this is happening, is again, a lot of employers are looking to front run the tariffs. They need labor, they need workers, they need to get these projects done and fast, so they're pulling people off the unemployment line. The real issue is, how long will this last? Because what we're seeing, at least from the regional Fed surveys, is there's a huge plunge in demand for new orders. There's also a big drop in backlogs. What that means is the existing workforce is going to find that there is a big drop in not just demand for goods and services, but a drop in demand for labor. Separate data on Thursday showed that orders placed within U.S. factories for business equipment barely rose in March. Again, this is a red flag for U.S. labor, suggesting firms are growing cautious amid uncertainty surrounding tariffs and tax policy. So once again, what we're seeing here is a drop in demand, but right now employers are not willing to lay off, but hold tight, because they're not going to keep people around if they don't have work. In a matter of months, we could see this unwind in a major way. And what the banks are preparing here for is a big decline in the U.S. economy, and they're preparing for the delinquency rate to surge. And here you can see the relationship between manufacturers and new orders of durable goods. We've excluded transportation, so you can see the real effect here. There hasn't been much increase in new order demand despite all the front running of the tariffs. And we got this overlaid against the unemployment rate, and you can see going back to the mid-90s, and you can see there's a deceleration in new orders, and that meant a deceleration in the need for workers. You can see the unemployment rate flatlining here. But by the time we get to the dot-com bubble around 2000, you can see manufacturers' new orders decelerated and then entered a large contraction. That put a lot of people on the unemployment line and sent the unemployment rate higher. We see the same effect going into the global financial crisis. And here you can see the new order book was actually rising going into the crisis, then collapsed right along with energy prices, sending the unemployment rate up. And now we're facing the same thing. Despite all of the front running of demand of the tariffs, what we can see is new orders barely even rose, suggesting that as that rolls over, what we're going to face is many Americans hitting the unemployment line, not having the money to pay all of their bills, and that means they're going to enter delinquencies, and this is going to put stress on the banking system in a major way, again setting us up for a potential another financial crisis. Now I want to know what you think. Former Fed Chair Janet Yellen said we'd never see another financial crisis in her lifetime. Are we on the cusp on another one? Weigh in the comments below. Because Pepsi says they're cutting earnings forecast as it predicts, quote, uncertainty in tariffs and consumer spending. And this is the real issue, is we're seeing consumers cut their discretionary spending, and we're starting to see it across the entire U.S. economy. Net sales for Pepsi dropped 1.8%, while their worldwide volumes fell 3%. Consumers have remained value conscious across brands and channels as cumulative impacts of inflationary pressures have strained budgets and altered food shopping patterns. Now let's put this in real words here. What Pepsi is saying is, look, we raised our prices, and what happens is people can't afford them. So they've cut back on what they're spending. They're trading down into other products, and we don't have an answer for this. And this is a real issue here because we continue to make the case that paychecks are shrinking relative to rising inflation. It's not just Pepsi is sounding the alarm. Found out from Chipotle that they're also seeing a slowdown in consumer spending as 2025 gets off to a rough start. The chain's same-store sales fell 0.4% during the quarter as consumers started pulling back their spending in February because of economic uncertainty. And again, I don't think this has much to do with just economic uncertainty. It's just when people see that their paychecks are rising and they can afford things like a burrito, well, they'll go out and spend it. But again, just like what Pepsi is seeing here, is consumers can't afford higher prices, so they're having to cut their spending on the discretionary side of the economy. And we could see this in our visitation study, where saving money because of concerns around the economy was overwhelming reason consumers reducing the frequency of restaurant visits. Now, this is interesting because what Chipotle is suggesting is that consumers aren't buying burritos because they're saving money. But this is interesting because it actually does have a link to rising inflation. Let's take a look at the personal savings rate in red against the consumer price index in blue. Let's go back to the late 1980s, and what do we see? A period where prices are rising, and the response is Americans start saving more. Now, if you're wondering why this happens, it's very simple. Because if people believe prices are going to rise and continue to rise, but their paycheck's not going to keep pace, they're forced to save money to buy the things they're going to need in the months and years that follow. And so what we see is this happens again going into the dot-com bubble. Initially, as inflation rises, consumers were very optimistic about the economy, so they drained their savings rate down. But when they realized the economy was going in a direction that wasn't in their favor, they started to increase their savings rate. They cut their spending. And this is something we go back and what the banks talked about in the beginning. They said they haven't seen the fact that consumer confidence has led to a decline in spending. But if Chipotle is right and the savings rate is going up, well, it means spending is about to collapse. We see that again going into the global financial crisis. The savings rate is on the rise as energy prices surge higher. We see it happen after that when we were facing a double dip recession. Again, inflation shot up and consumers responded by raising their savings. We see it happen going into the pandemic, and now we're seeing the same thing start to begin. And what we're facing is a rising savings rate as inflation is set to surge substantially higher. If that is the case, and that is a response we're seeing from consumers, then what it means is retail sales are about to plunge. And Nestle, Unilever signal more pricing pain to come for consumers. Despite the fact that everybody is saying we can't afford higher prices, businesses are still raising prices. And we're trying to take as much price as we can to cover our costs while being mindful of the consumer response and competitive environment. It's right to highlight soft consumer sentiment, not only in the U.S., but across the board. So what they're saying is, look, we know demand is weakening everywhere, but we're forced to raise our prices. The problem, again, consumers can't afford them. But not to worry, the Fed may run to the rescue now, as Fed's hammock says. A June rate cut move is in play. That is, if the data is clear. If we have clear and convincing data by June, then I think you'll see the committee move if we know which way is the right way to move at that point in time, saying already today that they make decisions based on uncertainty and that the data really doesn't matter. It's what they think they want to do. What she's suggesting is not only could we raise rates, but we might actually lower rates. We're not sure because we don't know what the data is. And even if we had the data, well, it doesn't really matter. Our next meeting is on May 6th to 7th, and here's what the real issue the Fed is facing. Let's take a look at the consumer price index in blue against real gross domestic product in red, because what Hammock is suggesting is we're facing a period where inflation is going to rise and likely substantially, and based on what we're seeing from consumers right now is the U.S. economy is going to slow. And this is what the banks are warning us about. They're saying, look, we're already seeing the delinquency rate rise, we're seeing demand slow down, and our expectation is the U.S. economy is going to further slow. Now, when you get that combination, you get stagnation. And when that happens, the Fed does indeed cut, and that is what Hammock is worried about. Let's overlay the federal funds rate in green, and what do we see in periods where prices are rising and the economy is slowing? That's right. The Fed is cutting. And what do we see going into the dot-com bubble is the same thing. Prices are rising, demand slows, and with a lag, the Fed finally starts to cut rates. It happens again going into the global financial crisis. This again due to energy prices surging, the discretionary side of the economy collapsed, the economy slowed down, the Fed cut rates, but it didn't make a difference. Of course, the big reason why is people that are out of work, well, they can't get a loan. Doesn't matter how low rates go, because what we're facing right now is due to the tariffs is a consumer price index likely to surge higher. We're already seeing signs that demand for the economy is slowing, and the expectation is it's going to weaken, particularly based on what the banks are saying. And that means maybe in June the Fed starts to cut rates, maybe they raise rates. I want to know from you, what do you think the Fed's going to do in June? Raise, lower, or just say they don't know? Because trade worries dominate the Fed's beige book as activity was little changed. Let's take a look, because several districts now reported that firms were taking a wait-and-see approach to employment, pausing or slowing hiring until there's more clarity on economic conditions. In addition, there were scattered reports of firms preparing for layoffs. So this is what the Fed really actually knows. It's not about growth. It's not about inflation. It's about the labor market. And what they're seeing is employers right now aren't willing to lay off. But based on their own internal data from the beige book, what they're hearing in their districts is employers are preparing to lay off. And that's one thing the Fed doesn't want to see, because if you want to get rid of inflation, the fastest way is to put people on the employment line. And at that point, you are facing stagnation. At that point, the Fed rate cuts don't make a difference. But don't worry, they'll run to the rescue like they always do, just with a lag. But just because the economy might collapse doesn't mean your trading account has to go down with it. We told our subscribers back on the 14th to buy GBTC, that's Bitcoin, on the open. And now, as of close of business yesterday, that trade is up over 10%. Here you can see in the notes for our Momentum Timer Pro subscribers, we said buy at the open. Now, what do we do each and every day? We look at the technical indicators like the RSI and the MACD, and we aggregate them together, but we also overlay the trend. And this is a big difference, because when you see a security get into oversold condition and people buy it, it doesn't mean the price can't go down even more. So you can see trends where it goes from oversold to oversold and even oversold again, but we add the trend to that and make the difference. What we do is we run this screen across broad equity, bond, currency, and commodity markets. We look at a 1 day, 1 month, 3 month, and 6 month window, and when it triggers on our report, well, not only do you get the report and all the tradable signals, I give you my opinions on the best trades in the notes with each report. I give you risk control levels, full tracking of all open trades and returns, a weekly update, and here's the best part. You get a 30-day free trial. That's right, your first month on me. All you have to do is use the links in the description below, grab the coupon code for your free 30-day free trial, and then you can join us making money trading the momentum signals. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.